Now today we shall discuss the methods of credit control. As far as the basic concept of credit control is concerned, we already have made a video regarding this. Kindly go through this. Here we will be discussing the various methods. See, in a brief, I'd like to tell you what basically is credit control. Credit control means regulation of credit. How much credit is there in the economy? Is it so vast it's going to increase, or you want to squeeze it? So this is the regulation, the manipulation of the amount which is being expanded or de-expanded in the country by the various financial institutions. How is that credit being going in the hands of the people, and how the people using it? Right, so you are basically trying to regulate the credit. Who does this? Obviously the central bank, the Reserve Bank of India, and it has its own objectives to do that. Why does central bank focuses on credit control, and what are the objectives? There can be various factors for the objectives. It is firstly the price stability. If there is uninterrupted supply of money in the hands of the people, everybody will be buying everything. Okay, so the prices will shoot up, the demand will be so high. The traders and the shopkeepers, they won't be able to meet the demands of the people because everybody is having so much of money. Now, the price stability, to get this term in the market, there has to be one principal teacher, the main apex bank, the Central Bank of India, who is going to control this volume of money, right? So the basic objective, I think, that first is the price stability in the economy. If there is no Reserve Bank of India regulating this credit, there will be no price stability. Again, economic stability of your country also depends upon the how efficiently the central bank is able to control your credit. Right, then there are further many more reasons for central bank to come into limelight, to maximize the employment of the people of the country. If there is no regulation of credit, you know how the bar of inflation and deflation is going to work, and there is no employment, there is no economic growth, right? So there are certain basic required objectives which have to be fulfilled, which have to be achieved by the Central Bank of India. Okay, so this was in short what is the objective of credit control. Now, as far as the methods are concerned, we categorize them into two parts. The first is the quantitative methods, also called the general methods. And secondly, there are the qualitative or the selective methods. Now, quantitative or general methods. See, these methods, they influence the total volume of credit in the system. How much money is being flown, this volume of credit in the banking system, how much credit are the commercial banks going to advance to the normal citizens like you and me? Is there going to be a limit on them, or commercial banks then uninterrupted loans and advances can be granted? So the total volume of credit, how much loans will be granted to them and on what terms and conditions? This is the quantitative or the general methods. Due to these methods, the lending ability, as I told you, of the commercial banks are being regulated by the RBI. Right? See, a bank is there. It has the power to give loans and advances for the various business ventures to anybody, XYZ, whosoever comes to the commercial banks, they will lend. Right? Now, the terms and conditions on which the commercial banks will advance the loans, that has to be decided by the central bank. So this lending ability, those terms and conditions will influence the lending ability of the commercial banks. And these restrictions are posed by the central bank. Greater the rules and regulations, lesser will be the lending ability of the commercial banks. They can restrict them to go forward. Okay. Now, these methods, they do not discriminate between the various sectors of the economy. What does this mean? When we discuss the quantitative or the general methods, we don't consider whether the loans and advances are being given to the primary sector or to the secondary sector or to the tertiary sector. So the quantitative methods, they don't have anything to do with the category of loans, category of the reasons for which the loans are advances. See, You may go to get a loan for the pharma sector. I may go and get a loan for the education sector. Somebody else can go to get a loan for the hotel sector, tourism industry. Now, these quantitative methods, as we will discuss in the second slide, they don't have anything to do with why the loan is being given. They will just consider this much loan has to be given. Now, it may be given to you for a particular reason, and it can be given to me for a particular reason. The reasons are not specified, and they don't pay, these quantitative methods, they don't pay any weightage to the reasons or the various sectors. To which sector is being the loan being advanced, they don't have anything to do with this. This is the number. Quantitative or the general methods deal with the number. They deal with the money rupee value. That's it. These methods do not give any importance or weightage to which the credit is being put to use. So just as I mentioned, when we talk about these methods, now the central bank will tell the commercial banks that if you have 100 rupees in your hand, you can advance 90 as the loan amount. Okay, so this is all. They will not tell, in this case, the quantitative methods will not tell the commercial banks that out of this 90, 40 has to go to the agriculture industry and say 50 has to go to the industrial sector. They won't say anything like this. They will just say that out of 100, please give 10 back and 90 you can advance. This is what the quantitative or the general methods are. So I repeat, they influence the total volume of money because they just deal with the quantity of credit. These methods, they are very well affecting the lending capacity of the commercial banks, of the national scheduled banks. How much will they lend? This will be decided by the monetary policy dealing with the quantitative methods. So they are indiscriminate towards all the sectors of the economy. They don't give any weightage or importance to which area is the credit being put to use. Now, the quantitative credit control measures are, number one, the bank rate, open market operations, and the cash reserve ratio. So, I have made separate videos on these topics. Very elaborate discussion has been done on those articles. Kindly go through those articles, study them well. Still, you have any doubt in asking what the bank rate or OMO or cash reserve is, feel free to ask me in the comment section. But please go through, it's a very detailed and a very nice article. Now I come over to the qualitative or the selective method. Now what are they? See, these methods are used by the central bank to regulate the credit inflow into the particular direction of the economy. Right? They are just opposite to the quantitative segment. Which way will the economy move? Will the economy be highlighting the pharma sector, or there will be concessions and subsidies being given to the education sector, agricultural industry, or the tertiary? So where are you heading your economy to? So they will discriminate between the various sectors and the various directions in which the economy is going to progress. Now, these methods let the central bank divert the investment into the priority sector. Right? So there will be the priority lending happens in which the central bank raises its own list of industries to which the lending has to be done. It may very well ask the commercial banks not to lend to the speculative areas. People start trading in betting and all. So they can be asked to abandon giving loans and advances to the speculations. Right? So for a better prosperity of the economy, we demark the sectors in which the commercial banks don't have to advance the loans. Obviously, all the money will be plowed back in the economy in the productive investment areas. Now, these methods affect the type of credit. Type of credit, not the volume of credit. Volume of credit goes to the quantitative methods, and the type of credit. How much margin money has the bank to keep to advance a loan? Like, supposingly, I go to the bank asking for a 1 lakh rupee loan. I have to invest into business. Now the bank is going to ask me for a collateral. Nobody is going to give the loan like this, and I offer the bank a collateral also. Okay, of 1 lakh land. I have a piece of land worth 1 lakh, and I go to the bank for 1 lakh loan. Will the bank give me loan for 1 lakh? No. It will keep a little bit margin. It may give me for 80,000 rupees, keeping 1 lakh land in hand. So this is the margin requirement which every bank has to keep. So such type of things are dealt in with the qualitative or the selective control methods. what type of credit has to be given. Right now I want to finance say a car, or I want to finance a washing machine or a microwave. Now how much money, earnest money, I have to give in one go? How much will be the number and the volume of installments which I'll be supposed to repay back the amount? So all these things are being controlled by the central bank, keeping in view the economic situation of the country. Okay, so these type of methods, they affect the type of credit. They also affect the composition of credit. How much credit, what type of credit, in which direction, not the size of the credit. I repeat, the size of the credit, it goes in the quantitative segment, right? Now comes, what are the qualitative or the selective control methods? There is margin requirement, regulation of consumer credit, rationing of credit, moral suasion, publicity, and direct actions. There is a separate article for these 6 qualitative credit control measures. Kindly go through them, study them well. Any doubts, please ask me. So here comes to the end of the article. Thank you for watching. Please like and subscribe to my channel. Stay safe, stay blessed.